Hey, it's Pete. Have you ever wondered how some people juggle a full-time job and make money trading stock options on the side? Well, in this video, John Napolitano, who is the head trader for a $42 billion fund, shows you how to avoid the biggest mistakes beginners make when trading options with their full-time job. He's also going to discuss which option strategies can minimize risk if you're not always monitoring the market full-time, and the best strategies to use in today's volatile market. Enjoy today's training and leave a comment below the video if you have any follow-up questions. Speak to you soon. Hey, John, we got a bunch of new members in the community in the last 30 days or so, I guess because the market's at all-time highs right now. But a lot of them, almost probably 90% of them, are trading part-time while they're working full-time. So I thought that that's going to be an interesting kind of follow-up to the new members coming in. How do you trade options when you have a full-time job?
Well, hey, Pete, that's a great question. And it's actually a great way to get started. If you start by having a full-time job and trading options part-time, it sort of takes the pressure off. You're able to refine your strategy and your style and your personality and your plan at the same time, potentially earn an extra income. So it's a great way for everybody to get started, actually. So the best way to do it is actually swing trading, which we talk about all the time. Day trading obviously requires a little more hands-on. It requires being attuned to what's going on intraday. But there's absolutely nothing wrong with implementing some option strategies intraday while you're working full-time or part-time, and you don't have to like babysit them all day long. These are things where you have a time frame of maybe several weeks or several months where you don't have to watch every single tick. You don't have to trade that way necessarily.
Which ironically, that's the reason most people want to trade in the first place, is not to be glued to the screen all
Absolutely.
day. It's not quite set it and forget it. There's obviously still trade management stuff, but you don't want to be getting in and out every day if your goal is to basically be earning yourself some more time.
Yeah, absolutely. There's three main types of trading. And as a new trader, you have to be aware of what they are. There's day trading, which most people are familiar with, that you could trade stocks and options for. It doesn't matter what asset class. But then there's swing trading, which allows you to hold things overnight or up to several months or several weeks. And there's position trading, which you could hold things up to a year. So you have to figure out what makes the most sense for you and your personality, as well as your time frame and your work schedule and everything else.
So I actually have a bunch of questions here from people thinking about coming into the community and people that just started. So I'm actually going to start out with the first one. What are the biggest mistakes beginners make when trading options alongside a 9-to-5 job?
Oh, man. So trading options, the biggest mistakes are, making decisions too quickly, for instance, doing things where you're essentially, like I said, paying attention to every single tick. When you're selecting your option strategy, selecting the right expiration dates, or, selecting all the right expiration as well as strike price and stuff like that, you have to have a strategy that basically allows you to sit through things for several days or several weeks. And that's what we teach our community. You basically look at some longer time frames, or you also look at your particular trade within context of a larger basket of other trades. So this way, not one single trade matters in your overall weekly, quarterly, or even yearly performance. And that's what we teach our community in the options group here. We basically say, listen, think about the overall markets, look at the overall sectors, pick the best underperforming and outperforming names to go either long or short, and make decisions that way.
I know that your trading strategy and your thought process is a little bit different as having, managing a fund back in the day. Can you explain a little bit for the beginner trader? It can sound daunting saying building a basket or building a position. Can you explain what it means to build a portfolio as opposed to relying everything on just one options trade?
Yeah, absolutely. That's a great question, because I know it could be a little overwhelming, and the whole idea of watching multiple trades. Well, how am I going to have time to do all of this? But you have to think in terms of if you're putting together a group of trades at different times. It doesn't require that much time. It doesn't require as much babysitting as you might think. And the advantage to doing that is, like I said, not one single trade matters. So if you put all your eggs in one basket, so to speak, if you're trading one or two things at once, that could potentially be detrimental if the market goes in a different direction. So what we try to do is put together strategy where you're constantly creating an optimal group, where essentially you're adding some, you're getting rid of others, and others you're taking profits, and so on and so forth, where you're constantly just monitoring it a couple of times a day. It's really not as much work as people would think. It's more a matter of just having the strategy in place and having the overall plan in place.
So I'm going to throw something on the screen right now, John. The VIX, right? So the volatility index is something that is obviously widely known in both equity trading, but obviously more on the stock side. So the VIX right now is pushing down even lower at 18. I'm going to throw a scenario at you just so you can everybody can think through how you talk about trades. VIX is below 20, heading down towards 18. The stock market is sitting at or near all-time highs. Volume is very light overall because of the election that's coming up in a few weeks.
Sure.
What's your thought process on putting together trades right now with the VIX down there and the market at all-time highs and the indecision with the election right now?
Yeah, I mean, the election definitely is hanging over as far as you have an unknown in a couple of weeks, right? And it's not a matter of even who becomes the president. There's just an unknown factor that the market is that's lingering. You also have the geopolitical that's going on and everything else. But what I tell people is, if you're worried about everything in life, you're never going to trade. You know what I mean? There's always going to be something. I know there's, election cycle is a little bit unique. It's fine, but there are still great opportunities, and we are in a bull market, and markets keep making all-time highs. So if you sat on the sidelines for the last 6 months, you would have missed tremendous opportunity. So to answer your question, when you see the VIX at 18, it's off its high of around 2021 of a couple weeks ago. But basically, the VIX is still historically elevated compared to its average. So the average VIX is somewhere between 14 and 15 for this year. And when you look at a VIX being 18, you could say to yourself, well, it's slightly elevated. And what that tells me as an options trader is I should be looking to not necessarily buy just calls and just puts. That's what a lot of new option traders do, because it's the simplest strategy, really. You buy a call, or you buy a put if you're bearish. But unfortunately, when you're overpaying for options, that could be a detrimental strategy. And what I mean by overpaying by options, if you have a VIX that's somewhat elevated, that means every option price is somewhat elevated, because the volatility index is kind of priced into the price of premiums. Now, some stocks historically have higher vol than others, but when the whole overall market tends to be a little more volatile, all option prices tend to be a little bit more volatile. So that means that you have to have a plan in place that allows you to adjust for that and make changes. And I think that's one of the great things we teach in our community.
So I want to touch on this a little bit, just for clarity, because you mentioned most option traders will kind of get into that lottery ticket mindset where they're just always buying a call, for example, right?
Yep.
But one thing that I've noticed with you that you've kind of educated very well on, the difference in when is the right time to initiate a spread as a debit versus a credit. And right now, we obviously have the VIX at 18. Is that first, can you define what it means, debit spread versus credit spread for an options trader? Why that's an advantage way to trade as opposed to just doing an options call or an options put, and what it means, how the VIX would make you look at one side or the other?
Absolutely. So in stock trading world, you have two choices. You could either go long or you can go short, meaning you could take a bullish position going long, or if you want to take a bearish position where you want to bet against the market, you would sell short a stock or bet against that particular stock by borrowing stock. In options land, you have four choices. You can be bullish or bearish by buying a call or a put, but then you have to decide whether you are debit or credit, because you can buy a call, which is bullish, you can sell a call, which is bearish, you can buy a put, which is bearish, and you can sell a put, which is bullish. So buying a call and selling a put is bullish, and buying a put and selling a call is bearish. So you have four choices. And the way if you could understand that concept, if you kind of nail down those four choices, you basically have 99% of the problem solved. You basically understand that I could either be an option buyer when premiums are low and cheap and volatility is low, right? Hint, hint, right? You want to be a debit trader when volatility is low. When volatility is elevated or even high, you want to lean more towards the credit side. Now, when you mention debit spreads, you can buy a call and sell an out of the money call and lower your overall cost that way, that's still a net debit trade. That essentially you would do in an environment like this. In an environment like this where volatility is somewhat elevated, always using some sort of a debit spread usually makes the most sense. Now, there's always exceptions. If you have a name like Coinbase or Tesla or something that has an unusual high volatility, a credit spread might be more appropriate, where your main trade is the short side. So you're saying, let's say, if I'm bearish, I'll sell a call, and then what I'll do to protect myself is I'll buy a call on top of it in order to, and not have unlimited loss, like a naked call, for instance. And if you put those two trades together, you will have what they call a net credit, which is called a credit trade. So there's just four choices. It sounds like it could be a little bit tricky, but it's really not. There's only four main choices to make, and that's what we cover in our community, when to make which choice at which time. Right now, with volatility being what it is, being more towards the debit side makes sense because volatility we're not in panic mode or anything like that. It's just a little bit elevated. So premiums are somewhat higher than they normally are.
Okay. So next question. Can you make consistent profits with just a few trades per month?
Absolutely. That's the best way to do it. If you look at sometimes doing too much, and you've done this too, Pete, you've ran a trading desk, so you know exactly what I'm talking about. Sometimes doing too much, trading too often could be a detriment, not only from a commission standpoint, because you're doing all these trades, but also you're overthinking and you're not taking your best trades. So by doing a couple of trades a month, picking your best of your best and putting them into your basket, like we talked about, that's a fantastic recipe for long-term success.
What would be an example of trading for income, trading options for income?
So when people talk about trading options for income, and I see this on videos all the time, what they're referring to are credit trades. Because when you're doing a debit trade, whether it's a long call or a long put, you have to pay for it. Obviously, when you're buying an option, just like when you buy a stock, you're essentially paying. But when you sell an option, when you're a net seller or a net credit trader, what you're doing is you're taking on an obligation of something, and you're going to receive a premium for taking on that obligation. So, for instance, if you own a portfolio of stocks and you decide to sell covered calls against those stocks that you own, and you're comfortable having those positions removed from your portfolio at certain prices, you're going to receive income for taking on that obligation. Same thing if you have a portfolio full of cash. Let's say you have $1 million and you have no money in stocks right now. The money's just sitting in cash. You could sell puts where essentially if the stock gets to a certain level or strike price, you're going to get assigned 100 shares of whatever stock you might be interested in. So these are strategies. Those are income generating strategies. When they talk about trading for income, that's pretty much what we're talking about. But you could also trade debit spreads as well for income as swing trades as well. But when people refer to income trades, that's usually what they're referring to.
So we're in the middle of earnings season right now, and one of the most common questions that we get on the option side is earnings season's here. I want to take advantage of these, these big monster moves. So, for example, Morgan Stanley, the stock kind of paused a little bit up over here, rallied up prior to earnings, and then earnings now it's still continuing to go. Now, on the equity side of things, I'd be talking about, well, we need a place to manage risk. If the stock really hasn't slowed down, we're kind of buying it beyond the optimal entry. But I think the option side has different perspective of that. You said you have four different ways of looking at this, that you can take advantage of that volatility in a way where an equity trader would be waiting for a better spot to manage risk, and only one of the limited ways that we can get involved.
Yeah, I mean, there's so many different ways to play an earnings situation with options that some are more safe than others. Some require a little more speculation. Some require you to just be kind of sort of right, like horseshoes and hand grenades. And what I mean by that is, you have such an outsized move when there's an earnings announcement. You don't really know what the outcome is going to be. So problem number one is you're trying to guess direction, right? Problem number two is you're trying to guess the reaction. So if the earnings news is favorable, then okay, that's great. But does that mean the stock's going to go down, or does that mean the stock's going to go up? I've seen companies beat earnings and still go down. That could happen if it's fully priced into the news. On top of that, the overall market could take the stock down, Or you could get an announcement bomb from Wall Street. You get like an analyst downgrading a stock or upgrading a stock after the announcement's been made. So you have all these landmines you have to kind of dance around earnings season. So to me, the safest way to do it, if you're going to speculate on direction or something like that, you could do something like an iron condor, where you're picking a big strike zone. You're basically saying, I'm going to receive income where if it's within a certain tolerance level. That's one way to do it. So that's more of a low reward, low risk, higher probability trade. So with options, there's always a trade-off. What's your risk reward? What is your probability of success? And what is your ultimate risk reward? These are all things you have to kind of factor in when you're making those decisions. So that would be one way to do it. Another way to do it, if you're going to do the simple kind of rookie way to do it, if you're going to buy a straight call or a straight put, you have to realize that implied volatility going into earnings could double or triple. So you have to be very acutely aware of what your break even is going to be. If you buy an at the money Morgan Stanley option for, let's say, $10, that means that Morgan Stanley has to go up by $10 in order for you to even break even. So what would be your reward to risk on something like that? To have a 2-to-1 reward to risk, Morgan Stanley would have had to go up $20. You know what I mean? So that kind of, and you have to keep in mind, if Morgan Stanley sinks 10%, because, again, it's an unknown, you're going to lose the whole $10 because you're not going to be able to recover your earnings. Your premium on your option is going to basically go down to zero. You have to realize when you're buying an option, the advantage is the implied leverage you have with, one contract equaling 100 shares. However, you have a time frame to deal with. So you have to pick the right expiration date. And you have to be aware that if you pick a short expiration date, you're not going to recover in time. You could lose the whole thing. And that's where rookie option traders lose all their money.
So a lot of leverage and perfect timing. That doesn't sound like a good
high risk, high reward, low probability trade. So there's nothing wrong. I don't like to begrudge anybody when they take a chance or when they try to speculate on earnings, but be aware of what you're doing. Be aware that you're in a high risk, high reward, but low probability situation. So to me, I'd rather do something like an iron condor or a little bit more of a complex strategy, or you could do a targeted butterfly, which is one of my favorite. That's a more speculative trade where you're kind of picking a certain strike zone. And if you kind of nail it perfectly, you could have as much as a 4 or 5 to 1 potentially in a situation like that. But again, it's a lower probability trade. That one's a little lower risk though, because targeted butterflies tend to not cost as much as a straight call or a straight put. So there's always a trade-off, and that's where the community is so important. That's why learning to trade options the correct way with the right situations is key to success.
Yeah, I think one of the things that a lot of people miss about successful trading is there's trade management after the trade idea, and I think that's a big part of community.
Yeah, we don't live in a bubble, so you could have a fantastic idea. All my trade setups, if you look at the Discord channel or if you look at like my newsletter and all the stuff that we do, every trade setup I do has the same format. It's always, okay, well, what's the reason why am I getting in this trade? What is my edge? What is my perceived advantage I have for entering this particular trade at this particular time, as opposed to the other 10,000 stocks I could select, right? So that's step one. Then step two is, what's my target? Then what's my entry? What's my stop? What's my time frame? And what's my sizing? And these factors are all the things I do before I even enter a trade. It doesn't matter whether it's a one-day trade or a trade I plan on sitting in for several weeks. It's always going to be the same type of setup.
So let's say somebody never traded before. They have a full-time job. They're watching the stock market hit new all-time highs right now. And like, oh my gosh, I'm missing out on all this beautiful money, right? In your experience, what would be the first two things? Let's say you're mentoring somebody. What would be the top two things that they should focus on for the first 30 days?
The first thing they should focus on is their overall plan and strategy. What's their, how much capital do they have to commit to this? How much time are they going to be willing to dedicate to learning this the right way? Coming up with a game plan that makes sense for not only their work schedule, but their personality. So some people are more introverted, some people are more extroverted. That's going to go into your decision-making process. So developing, understanding yourself is very important. I know that's a kind of a psychological aspect of this, obviously. Once you understand your pros and cons, no personality is necessarily perfect. Everybody's different. So you have to realize, okay, well, if I'm an extrovert, and that's my personality, I tend to be more extroverted. That basically tells me that I'm going to listen to people more. I'm going to like to trade in groups more, which could be good and could be bad. It could mean I'm going to listen to everybody's opinion more than my own, right? And that could be a weakness, right? So now conversely, just to pick on the introverts now, introverts, they tend to be very analytical, which is great. They tend to like dot their I's and cross their T's, right? But that could mean analysis paralysis. That could mean under trading. That could mean always waiting for over confirmation before making a decision.
Those people
So,
usually get into trade too late because of that reason.
because they wait for too much confirmation. I need to have everything in a row. And we all know that the stock market is a moving target. So you're never going to have a perfect mosaic. You're always going to have a couple of tiles missing. You know what I mean? And you have to, you know what I mean? And you have to always be aware of what tiles are missing and what you got to do. So whether you're introverted, extroverted, whatever your personality is, okay, you have to put some guardrails up. You know what I mean? Like, those bowling rails when you go bowling. For the kids, you kind of have to put those up and say, well, I don't want to overtrade. I'm extroverted. I'm going to turn off the news. I'm not going to watch CNBC all day long. You know what I mean? That was a big thing. I was a news junkie when I first started. That was one of the worst.
I stopped that years ago.
Yeah, that was probably one of my worst qualities when I first started doing this. I was always, watch the news. What's going on? What's happening? You know what I mean? And it's great to know what's going on, but you can't be making those type of decisions. It'll drive you crazy. So that's one thing. And then the next thing is develop your risk management plan. I have a portfolio management background, and I use that to full advantage. That's how the whole basket strategy sort of got born. I believe that not one single trade should matter in your life. If you're going to bed at night and you're thinking about the trade that you left and it's still out there and you're thinking about it while you're in bed, it's probably the wrong trade or it's probably too big. And that's kind of where I started to formulate this whole idea of, well, what's the market telling me? How bullish or bearish is the overall market? What sectors are underperforming and outperforming? So where should I look for my bulls and where should I look for my bears? And then drill down to the best of the best or the worst of the worst, if I'm going short, for instance. And then narrow that down further to the best ideas possible based on chart setups, based on technicals, and so on and so forth. And that's basically it. Once you have that small list out of those 10,000 names, then you could start putting together the right strategy for what you're trying to accomplish.
Okay. You actually took the next question. How do you find the right stocks for options trading if you're pressed for time? So maybe that's a little bit different, adding that to the end.
That's a great question, because again, if you have a full-time job, screening for stocks, you're like, oh my God, how am I going to sift through 10,000 names? It's actually surprisingly simple. And what I mean by that is the process doesn't really change too much week to week. So once you get good at it, once you practice a little bit, it's very easy to drill down to a list of 20 or 30 things to kind of keep an eye on, as opposed to watching 10,000 different things. So we have a criteria for doing that. We obviously don't change that from week to week. Like just as an example, there's volume, there's beta, there's overall, what the trend is. There's criteria that really isn't going to change week to week. And those are things that we add into our filters that give us this dynamic list every single week. So the process doesn't change too much, but the names will probably change from week to week, depending on how the markets react.
Okay. How can beginners avoid over trading options even when time is limited?
Yeah. So step one, turn off the news, like I just said, right? That's one. What you have to do is if you follow my format, which is the TESTS format, and it's not something I invented. Other people call it sets. Other people call it different acronyms. But basically, if you have a target, entry, stop, time frame, sizing in mind, if you answer all those questions, you kind of you really can't go wrong in the sense of your trade setup. Obviously, you're going to have winners and losers, but as far as why you got into that trade, what was the setup, what was I thinking, you can't think of those things when you're in the trade. When the bullets
it's so different, John, thinking through the trade and what you plan to do before you have the emotional attachment to it.
Yeah, 100%. When the bullets start flying, you don't want to be thinking. You know what I mean? What you have to do is you have to say to yourself, okay, I got into this trade for this reason. I'm in the trade now. And the second you hit that button, has anything changed? So that this goes into my exit strategy for a trade, right? If If, let's say, it reaches my target, obviously I'm happy, I make a profit. That's a no-brainer, right? I might have multiple targets, by the way. That's a little more complicated, but you could have target 1, target 2. With options, you could have multiple targets. You could buy a call option out several months, and you could sell premium on a monthly basis against that option, which gives you tremendous income potential, right? That's one of the things that I love to teach. But aside from that, the exit strategy, what you essentially want to do is not only have a target, but hey, you have to ask yourself, if you're in a losing trade, before you get stopped out, obviously you have to have a stop in mind. Usually my hard stop is 40% or 30% of my premium, right? So that's a hard stop. If the premium goes down by 30%, I'm finished, right? That's a hard stop. But sometimes you might wake up and it might be down 10% or 20%. And you're like, okay, well, I'm in a losing trade. Should I get out? Should I not get out? That's where I think people get confused. That's where I think a lot of the,
that is kind of the phantom zone where it's like, I didn't get stopped out. I didn't hit my target.
It's just bouncing around and you're like, oh, wow. So I have a second exit strategy, which I teach our community is, has your edge disappeared? The reason why you got into this trade. Well, go back to that first paragraph. What's your edge? Right? Okay, markets are high. Markets are reaching all-time highs. We're above our 20-day moving average. We're above our 50-day moving average. This particular stock is in a fantastic sector. Semiconductors did great this week. Taiwan Semiconductor up 10%. So I'm just kind of buying this stock because it's in that group, right? So that's a good reason, right? So, okay, so now fast forward 5 days, you're in the trade and you're down 10% on your premium. Did you do anything wrong? No, you didn't do anything wrong, but maybe the environment changed. Did the NASDAQ break its moving average? So you're thinking in the overall market, not the name you're in. You're thinking, if the market drifts lower, I don't care what you're in, you're probably going to be losing money because 80% of the movement of a stock has to do with the market, not necessarily with what the stock is doing. And that's another thing new traders don't realize, that, the overall market conditions, if they change, you can have the best idea in the whole world, you're still going to lose money. So, has that environment changed? And usually the answer to the question is yes. And if that's the case, then I would consider an early exit or a reduction, which I know you like to do, a reduction in your overall size. So if this was a great idea, maybe it's still a good idea, but it's not a great idea anymore. And then what I would do is I would reduce my position or consider an early exit if my edge disappears.
I actually did that in the trade today in Chewy. We've had the trade for about a week and a half. Feels like it's been 10 years because the thing really hasn't moved at all for what we expected it to do.
Yeah.
And we first discussed the possibility of reducing share size, even though we still like the idea. And then this morning, I took a small loss on the position. I'm like, it just didn't have the same.
It didn't do what you thought it was going to do.
It didn't do it yet, and especially within a reasonable period of time. Like I don't necessarily need everything to like fly in my direction as soon as I put the trade on, but within a reasonable period of time, especially with the market making all-time highs, I'm like, you know what? I'd rather just take a small loss on this, get the capital back, and allocate it to a new idea that I like better at that moment.
Yep.
And just kind of, say it in a little bit different way, which you said it perfectly. But I talk a lot of people. You can get on the road and drive 70 and be perfectly okay with that, which is you putting on the trade for the first time. You're super comfortable. You have a lot of conviction. But then 2 miles down the road, it starts raining, or now you're in traffic. You got to change. It's the same thing in the market. We have new information. And I think that little part is a big part because the circumstances changed from your original plan. And you have to be aware that you have to make different decisions or consider a different decision.
Yes. So consider an early exit, but that has to be part of your plan before you get into the trade. This is where you're not a deer in the headlights when it's actually happening. And I think that comes with a little bit of practice and training and experience, you know what I mean? And that's the most important thing, which leads me to the question you mentioned before, like what you're talking about before with Chewy, for instance. You were sitting in it. Now, as a stock trader, what you're really giving up is opportunity cost. You're giving up the ability to potentially, because everybody has a limited amount of capital. Let's be clear about that. No matter how much money you have, right, or don't have, you have X amount of money in your account. You have X amount of decisions that you can or can't make. And if you decide to get into Chewy, you have to make a decision. How long am I going to sit in this thing before I start to move on to something else? Yep. Now, in options land, that decision gets made very quickly for you because there's something called time decay. Time decay could be your enemy or it could be your best friend in option land. It's a component that gets priced into an option premium. So when you buy an option, what I like to tell people is you're renting a stock, and you're buying an ice cube, basically. And ice cubes melt. If a stock stays the same and you're a stock trader, you're only losing time value, right? Because you could be potentially like opportunity cost lost, right? But when you buy an option, every day you lose X amount of dollars by sitting in that option, which is another mistake new traders make. They buy a call option thinking they could sit in it forever if it doesn't do anything. And when the stock bases for a couple of days, they realize that they lost $50 or $100 because it just sat there. So as an option seller, that money goes in your pocket, by the way. So that's another advantage to being an option seller or a credit trader, because time is on your side. But yeah, that goes into the factor of consideration. If I have a strategy in mind for a trade, and it takes too long for it to happen, if I think it's going to happen in 2 weeks and it takes longer than I thought, I got to get out, or I have to maybe reduce my position or something like that.
So obviously, people working full-time jobs are kind of focusing on that full-time job trading options. The question here is, I have to be at work at 9 o'clock. The market's open at 9:30. When do I place my orders?
Well, with today's modern technology, there's a bunch of ways you can do that. Obviously, you can leave something called a bracket order, or a contingent order. So there's different types of orders you can leave that allow you to just go about your business and not necessarily worry about being there when the actual order gets filled. As long as you have your plan in place, as long as you set your intention, and then let the stock market do what it does, you will either get into that trade or you won't get into that trade based on the type of order that you place. So a contingent order would be based on the underlying stock. If this stock gets to this price, I want to get in. So you would analyze the chart ahead of time. You could do it the night before and say, hey, if it gets to this support level, or if it gets to this area of a moving average, whatever your entry criteria might be, then it will trigger an order for you to get into that trade. Same thing, same thing on the way out too.
So, John, we covered a lot of high-level stuff today. We were kind of answering questions specifically from new members or people thinking about coming into the community. We're actually going to host a webinar next Wednesday. We're going to get into a little bit more nitty-gritty of actually the implementation of some of the stuff that we've been talking about today. So if anybody watching this video, whether it's live or on a replay, can click into the description. There's going to be a place for you to sign up for that training, which is going to be live. So just go into the description, fill out your information real quick, and we'll see you live on the next event. So, John, any parting words for somebody full-time looking to trade options part-time?
Just some parting words. That is actually the preferred way I would begin doing it. So don't be shy. Don't be afraid to try new experiences and to potentially add this income stream to your life, because it could be potentially something that really changed your life. It certainly changed mine. And I think that one of the things you have to realize, anything in life takes a little bit of training and skill. But it's not impossible. It's a very simple process that you can follow, and something that you can do while you work either full-time or part-time, for sure.
So I know one last question. Somebody who is working really hard on studying everything they could possibly find on options trading, books, YouTube, PDFs, everything, but they just can't turn the corner. They've stopped losing money, but they're not profitable yet. What is that person likely missing?
They're probably missing a plan and a strategy. They know all the mechanics. They know the definitions of every option strategy. They might even know when to use them and when not to use them. But what they're lacking might be putting it all together in that basket. How many bulls should I have this week? How many bears should I have this week? How many neutral trades should I have this week? What's my optimal portfolio for the week? Or am I just all on theory and not on practice? So the best way to mitigate that is to just go out and do it. You could start with a sim account and practice, develop your strategy, and obviously join our community and learn and get some of our coaching. But on top of that, just practice and to just perfect your strategy and your plan. I think that's what's usually lacking.
So it sounds like they're very tactic driven and not strategy driven. Tactics is like, all the lingo and everything. You can speak options fluently, but you don't necessarily know how and when to use it.
Exactly. So there are a lot of things to learn. I find that it could be overwhelming if you read a book. I find a lot of people that I talk to, they are very interested in trading options. they pick up a book on options, and then they're quickly not interested in trading options. The book is like this thick, and they just like, oh my God, there's so much. It's really not that difficult. You know what I mean? I am no rocket scientist by any stretch of the imagination, and just putting together simple strategies that are repeatable, that you can do either full time or part time, and that are repeatable in the sense that, you know, maybe the names change, maybe the stocks that you're going to trade changes, but the process that you derive to get there does not change every single week.
All right, John, thanks so much for your time. I'm looking forward to that training next week. Have a great day.
I'm looking forward to it. Talk to you then.
Bye-bye. Thank you, everybody.
Take care, everybody.